Welcome to TSAT. In the last two sessions, we discussed about measures of national income and inflation. Today, we will be discussing about a very important concept, monetary policy. This happens to be the most important part of the entire Indian economy, and majority of the questions in competitive examinations would be mostly from monetary policy and topics related to money and banking. So, we will be discussing about what exactly is monetary policy, the concept of monetary policy, what does the purpose the monetary policy serves in an economy, and how RBI uses various tools to control the supply of money, and what would be the actions of RBI upon the economy. That would be our discussion. So, let me make it clear with respect to the term monetary. So, many of us would have this confusion when it comes to monetary policy. So, this seems to be a term that seems relatively complex to you, but the word monetary is derived from a Latin word that is nothing but monetarius. Monetarius simply does mean money. So, the literal meaning of the word monetarius in Greek is money. So, any policy that deals with supply or altering supply of money is what we call as a monetary policy. So, if you look at what the definition of monetary policy refers to the policy of central bank with regard to the use of monetary instruments under its control to achieve the goals specified in the act. So, the definition of monetary policy here in this case, if you look at this, is what I have picked up from the RBI's website itself. So, according to RBI, the monetary policy refers to the policy of central bank with regard to use of monetary policy instruments under its control to achieve goals specified in the act. So, what are the goals that's been specified? That what we will be discussing as part of this session, and what are the instruments RBI has under its control to alter the supply of money? That would be our next part of our discussion. So, if you look at, my dear friends, the RBI, I think most of you know, RBI has been come into being as a result of RBI Act of 1934. So, this is what many of you might have been studying as part of your modern history, isn't it? So, now let us come back to what exactly are the goals of monetary policy. So, why do we need this monetary policy, and what does this monetary policy tries to achieve? Okay. So, if you look at the first and foremost object of monetary policy is to promote growth and employment in economy. So, I think you could understand how growth and employment are correlated. So, imagine in the last class I already discussed what does growth mean? Increase in production of goods and services in an economy. So, whenever economy is producing more and more goods and services, the economy is set to experience more growth. That is what we discussed in the session, Indian measures of national income and growth. So, when the production increases, do you really think don't you think that we need to employ more and more resources? Because if you want to produce 10 chocolate bars, you need to employ some people. If you are producing 100 chocolate bars, then the number of people to be employed to produce the same amount of chocolate bar, the number of raw materials to be employed to produce the same chocolate bar is, then more and more chocolate bars increases. So, henceforth, whenever you end up concentrating growth, that obviously results in increase in employment opportunities in the country. So, that is the first and foremost objective of monetary policy, promoting growth and employment. The second is maintain price stability. So, when it comes to the word price stability, and don't get confused with the constant prices, it's stability doesn't mean constant prices. The objective of RBI is to ensure that the prices of goods and services in the economy neither steeply increase nor steeply decrease, or they doesn't rise at a very high level or they doesn't fall at a very high level. So, in simple terms, the purpose of the meaning of the word price stability or maintaining price stability simply does mean RBI tries to contain the phenomena of inflation, and we already seen that inflation is a phenomenon of rise in prices. So, RBI at the same time also try to contain the phenomena of deflation, that is fall in prices. So, the RBI ensures neither the prices steeply rise nor the prices steeply fall in a very short span of time. The RBI tries to keep the prices relatively a certain the rise in price or fall in price within a reasonable margin, and that is what's the reason I said the RBI the second important objective is to maintain price stability. The third one is to maintain exchange rate stability. So, what do you mean by an exchange rate? I think these days you might be aware of the rupee almost has touched to 80 per dollar, isn't it? So, when I say exchange rate stability, the RBI tries to do everything possible to ensure this value of rupee against a currency like dollar or euro, pound, whatever it could be. So, the RBI tries to ensure the value of our currency in terms of foreign currency. And that is what's the definition of exchange rate. Exchange rate simply does mean the value of a currency expressed in terms of other currency. How many rupees that we need to forego to buy a dollar. That's the exchange rate of rupee versus dollar. How many rupees we need to forego to buy a euro. That's the exchange rate. When it comes to rupee versus euro. How many rupees we need to forego to buy a euro pound, isn't it? So that's what's the exchange rate of rupee versus a pound. So similarly, what does the RBI tries to achieve? The RBI tries to ensure that our rupee against a foreign currency would be relatively stable. It does mean rupee doesn't steeply fall somewhere around 85 all of a sudden, and rupee suddenly doesn't rise somewhere around 60, 65 in a very short span of time. It tries to ensure the value of rupee against dollar would be within a reasonable margin. That's what the stability does mean. So these are the three prominent objectives the RBI tries to achieve as part of its monetary policy goals. So that's what is being okay. So here in this case, you could simply imagine these are the monetary policy makers. So if you look at on the left side, they are trying to ensure the growth, okay, and at the same time they are trying to contain inflation. So why is it they has to stabilize or they has to contain both these things? So you could simply say they are trying to simply ensure that growth and inflation would be within a, okay, they are trying to manage both the concepts of growth and inflation. And we already discussed when I discussed the concept of demand pull inflation. Okay, so whenever an economy experiences growth, it is bound to experience inflation. The reason is with growth comes income opportunities. Okay, with growth comes employment. With employment comes income. More income results in more consumption results in demand, and that demand results in increase in prices. So whenever you have higher growth in an economy, the inflation is bound to rise. And if this inflation keeps rising at a very high pace, that would have a very huge adverse impact upon the growth of an economy. So that's the basic reason the monetary policy maker's job is to simply try to ensure both the growth and inflation would be relatively balanced. Okay, so if you only concentrate growth, that comes with a side effect, that's inflation. And if you don't control this inflation, that would have a very bad impact on the growth. Okay, so that's the basic reason. That's what the image simply says. Now let's go ahead and try to see how is this monetary policy formulated. How is this monetary policy formulated? So as such, we started with the definition that monetary policy refers to, okay, the use of certain policy instruments by the central bank to alter the supply of money, thereby influence the credit in the economy. But how is this decisions made? So if you look at as of now in India, my dear friends, like we have the fiscal policy and annual policy. I mean to say, you know that you many times you might have seen, isn't it? The budget is submitted in the first working day of February, and this budget is an annual financial statement, okay, or you call what you generally call it as a part of fiscal policy. This something similar to fiscal policy, even the monetary policy, the RBI would also have an annual monetary policy. And in India, we would have a review of this monetary policy. So whatever the policy the RBI has formulated and anticipated to be implemented for the next 1 year, the RBI keeps reviewing it and revising it once in every 2 months. And that's the basic reason we call this review once in 2 months that RBI takes is what we call a bi-monthly policy review. So for every 2 months, the RBI keeps reviewing the policy. So it does mean what is the RBI trying to do and what's the purpose of review of this policy? See, for a year the RBI might have a certain plan. This is the amount of money or this would be the interest rates prevailing in the economy. With this particular growth rate, let's keep these rates of interest or let the supply of money be certain amount. But over a period of time, okay, the economy might be experiencing certain issues, maybe because of some internal or external factors. So as a result, the RBI either need to increase the supply of money or decrease the supply of money to address various concerns in the economy. And that's the basic reason the RBI happens to keep reviewing the policy once in every 2 months. But before going, okay, so that is that's a regular practice as of now. But if you ask me, is it necessary that RBI has to go for only bi-monthly policy review? It's not necessary. Okay, recently you might have in the month of May, June. Okay, this is the, okay, so this today is August, okay. So in these, just on August 5th, we had a policy reviews. Okay, so in the recent policy review, the RBI also has gone for a sudden change in the policy rates or increase in repo rate just to contain the phenomenon of inflation. It's not necessary that RBI has to do the review only once in 2 months, but if it is required, the RBI could make the change in policy review at any point of time based upon the situation in the economy. So as of now, until 2015, in India, this so-called decision of changing the policy rates used to be completely within the control of RBI governor. But since 2015 in India, we happen to have a small change wherein, in fact, since the time Mr. Ujjit Patel has become the RBI governor, we have this change in the way the policy is implemented or the policy is being formulated, implemented and reviewed. So as of now, the monetary policy decisions is made by a 6-member committee. It's made by a 6-member committee. So it's somewhere around 2016. Okay. So And this 6-member committee consists of 3 members from government. I mean 3 members of this committee has been appointed by the government and they are outside of RBI. They are not necessary from RBI, and it's not necessary these 3 people has to be, okay, some public servants are working for the government of India. The government could appoint any 3 people who happen to be having an expertise in banking industry or simply economic and finance. So that 3 members are from government and 3 members from RBI, and by default one of these member happens to be the governor of RBI itself. So one among them could be the governor of RBI. And how is the 6-member committee decision? Okay, so how does the 6-member committee makes the decisions? In general, they meet once in every 2 months in Mumbai, okay, the RBI headquarters, and discuss and debate about the state of economy, and they come up with certain changes in policy rates. Okay, either they go for increasing policy rate or decreasing policy rate based upon the circumstances. So in general, my dear friend, the decisions are taken on a voting basis. The decisions are taken on a voting basis. So now you might be asking me, since there are even numbers, what happens if there is a tie among these particular people? In such case, the casting vote or the last word happens to be with the casting vote would be with the RBI. I mean the final say would be with the RBI governor itself. So whatever he says, that would be the final decision that would be prevailing. Okay, that is how, okay, since 2016 somewhere, okay, from September, Mr. Ujjit Patel has become the governor of RBI. Okay, we started simply making this policy, reviewing this policy with a 6-member committee rather than one person taking the decisions. So at the end of the day, all that RBI tries to achieve is simply to balance the growth and inflation. So most of you might be aware of that. Generally, if you look at any concept of economy, there is always a trade-off attached. Okay, so if you want to have a high growth, you need to bear the cost of inflation. We need to bear the cost of inflation. So high growth, then we need to bear the cost of inflation. And if you are trying to contain the inflation, that would come at a cost of reduction of growth, because if you are trying to keep the money tight, then obviously it would result in a fall in growth rate. Okay. So now let's look at what exactly is the RBI tries to achieve. The RBI, since it uses certain policy instruments to alter the supply of money, either it could increase the supply of money, or it could decrease the supply of money, because you know the fact that RBI has the purview or complete right with respect to altering the supply of money, with respect to controlling the supply of money. So as part of its monetary policy decision, RBI either could increase the supply of money or decrease the supply of money. So how does RBI increasing supply of money? So let's use with mere intuition. If the supply of money increases, for that matter, if supply of any commodity increases, what happens to the price of commodity? It becomes cheaper. Similarly, when the money supply increases, what happens to the interest rates of the money? Okay, what happens to the interest rates in the market? They decrease. When the interest rates are cheaper, what happens to the credit supply? Increases. I mean, people willingness to go for borrowing, more borrowing. Isn't it? When loans are available at a cheaper price, obviously people would be interested to borrow more and more money. And once credit supply increases, what do you think people would be doing with this money? They either go for consumption. Okay, majority of the people go for, okay, so the credit offtake is for consumption spending or for the sake of investment. So when more people borrow money and end up spending it, so obviously, or when more investors borrow money and spend it, invest, create capital assets, as a result, what would be the impact on the economy? The demand in the economy or the aggregate demand in the economy increases. When the demand increases, you know the consequence, the production of goods and services increases. As a result, employment opportunities increases. As a result, income of the people increases, and that would again further rise the demand. And that's the basic reason. Ideally, expansionary policy of RBI is used to help in revival of economy and promote growth and investments. So how does it promote growth and investments? Simple. When money is cheaper, people would like to, investors, not only investors, even consumers would also like to borrow more and more money and spend a lot of money. As a result, whenever RBI goes for a decreasing the interest rates, that results in decreasing interest rates, that results in increasing credit supply, and henceforth we call this as an expansionary policy, or we call it as an easy money policy, or many a times people also call this as a cheap money policy. So any term, either easy money policy, expansionary policy, cheap money policy, it does mean the same. And at the same time, the RBI, based upon the circumstance, could also go for the opposite of it. That means it could reduce the supply of money. How come? By simply increasing the interest rates. So simply what does RBI does, or how does RBI control the supply of money or supply of credit, is by altering the interest rates. By altering the interest rates. So if RBI goes for increasing interest rates, what happens to the credit supply? It decreases because people would not be interested in borrowing more money at a higher rate of interest. When credit supply decreases, I mean people are not happy borrowing, does mean the consumption in the economy decreases. At the same time, the investment demand also decreases. Rather, more people would be interested in saving rather than consuming it. As a result, what happens to the demand in the economy? That reduces. When the demand reduces, what happens to the prices? Many a times, the prices might end up reducing it, or the rise in price, the phenomena of rise in price could be contained by simply making money tight, and that's the basic reason. The other initiative the RBI happens to go for it is what we call as a contractionary policy, in general used in helping or containing inflation phenomena. And how does RBI does it? By increasing interest rates, by making money tight. Henceforth, RBI's initiative of increasing interest rates could be either called as contractionary policy or a tight money policy, or you could also use a term called dear money policy. My money has become dearer. It is very dearer to use this money because the value of money is increasing because the interest rates of the money is very high in the economy. Okay. Now let's look at the two extremes of the RBI's policy actions. Now imagine the RBI with an intention. The RBI with an intention to boost the demand in the economy ends up decreasing interest rates to very low rates. Now just imagine the RBI happened to decrease the interest rates. Let's say decrease interest to very low rates. But when people are not happy borrowing enough money because they are not happy that the economy is going to really revive. So in such case, whenever RBI goes for the extreme, or whenever RBI ends up going for enormous reduction supply of money, isn't it? Sometimes these actions might result in the trap of liquidity within the economy. So liquidity trap is a scenario where any further reduction supply of money or any further reduction on interest rates of the economy does not result in increase in credit supply or offtake of credit, because people might not be interested in borrowing money even at a very cheaper rates. That particular situation is generally what we call a situation of a liquidity trap. Okay. Now let's look at the other aspect. Now imagine in the name of RBI trying to contain the phenomenon of inflation, if RBI goes for increasing interest rates to a very high extent, in such case at very high rates of interest, neither consumers would be happy borrowing, spending, and nor investors would be happy borrow and invest. As a result, because of high rates of interest, since no one is interested in borrowing money and the money is not available at cheaper rate of interest, that results in a very different situation, what we typically call it as a liquidity crunch. Crunch does mean shortage, severe shortage. Okay, why is it so? Because the RBI happened to keep the interest rates very high for the purpose of containing inflation. So too much of increase in interest rates would have an adverse effect, and that extreme situation is what we call liquidity crunch. And too low rate of interest sometimes might result in a scenario, that's what we call as a liquidity trap. Okay, so these are the two extremes of RBI's policy actions. Now let's go ahead and look at what is the basic purpose of RBI, and beyond formulating the policy, monetary policy, what are the other functions RBI performs in the economy. If you look at, my friend, the RBI has been established on 1st April 1935 and it's been result of RBI Act of 1934. Okay, so I am not just going into the details of nitty-gritty of this RBI because these are the things you might be aware. But one thing you should be aware is that initially RBI has been floated as a private bank. Later it has been nationalized in 1949. So I will leave you the job of finding out the difference between the term nationalization. Okay, so this would be an exercise to you people. The difference between nationalization, privatization, disinvestment, and then strategic disinvestment. So do find some time and simply explore the difference between these particular terms. Okay, so it's not too difficult and it's very easy. If you could spend 2-3 minutes, you would be able to figure it out what exactly. So let's look at what are the various functions RBI performs in an economy. The first and foremost function RBI performs, as we already discussed, and since beginning of this particular session, this is what we are trying to understand. So one major responsibility of RBI is it formulates, implements and monitors the monetary policy. So the responsibility to formulate a monetary policy, implement the monetary policy and monitor it. I mean review it once in a while. Okay. So in good old days, the RBI used to go for a biannual, okay, once in every 6 months. Then later RBI happens to review for every quarter, once in every 3 months. During the 13-14, I mean during the 12-13, Okay, I mean almost some 10 years back. Okay, if you look at my friend, there were times where RBI also used to go for mid-quarterly review. That's been once every 45 minutes. But as of now, we have a bi-monthly policy review. So is there anything somewhere mentioned either in the Constitution of India or RBI Act? Not necessary. Okay, there do, I mean, okay, so what exactly is the review period? Okay, is it bi-monthly? Is it be quarterly? So it all depends upon the state of the economy. So what is the object of this particular initiative is to maintain price stability while keeping in mind the object of growth. That's the reason RBI tries to achieve or balance both the growth and the price stability. The second important function RBI performs is it regulates and supervises the financial system. So you be aware of the fact RBI is the regulator of banking industry. Okay, RBI is also into the business of regulating a money market. So I hope you understand the difference between money market and capital market. So if you look at in India, capital markets are regulated by SEBI, whereas money market is regulated, both banking industry and money markets regulated by RBI. Okay, so when it comes to money and capital market, it's a duration. So if your lending period or borrowing period more than 365, we generally call it a capital market, else we call it a money market. Okay. So if you look at the second important function RBI performs, it is also into the job of regulating and supervising financial system. Okay. So what's the object of it is to ensure that the public confidence in the system, protect depositors' interest and provide cost-effective banking services to the people. So most of you been also aware of the fact there is something called Deposit Insurance Credit Guarantee Corporation, which is a 100% subsidiary of RBI. And recently our Prime Minister has made an announcement, in case if you happen to lose money because of your bank gets closed. Okay, so when banks end up, like many companies, banks are all the business of simply raising money, lending money. That's what a bank does. Like every business, banks might also be exposed to some bad results. And imagine in the worst case, if your bank in which you have deposited money ends up getting collapsed, or it has become, the bank itself has become bankrupt. In such case, okay, you don't need to worry about the money you deposit in the bank. And recently our Prime Minister has made an announcement that the insurance, okay, the amount of money that you will be losing in case you lose money in the bank in which you have placed, okay, you will be getting an insurance amount up to, maximum insurance amount up to what, 5 lakh rupees. So that's what the RBI simply playing these kind of roles would help in inducing some confidence among the deposit holders, and that's the second most important function that RBI performs. The third is manager of forex reserves. So in fact, the custodian of forex reserves in India happens to be RBI. So many of you might have noticed the fact, okay, by somewhere in almost every Friday evening, the RBI makes an announcement with respect to the total forex reserves the RBI has accumulated by the end of the week. So RBI also plays a very important role with respect to managing the forex and also stabilizing the Indian rupee with respect to foreign currency, and acts as a custodian of forex reserves. So that's what's the objective says, to facilitate external trade and payment and promote orderly development and maintenance of foreign exchange in India. That's the third important function RBI performs. And the fourth one is, it is the issuer of currency. Who issues the currency? So you know, minting coins is generally what the government of India does, minting coins. When it comes to printing currency of any denomination, ideally it's what the job of RBI. That's what RBI happens to perform. Okay, so RBI issues the currency. So to give public adequate quantity of supply of currency notes and coins and in good quality, RBI does take the responsibility of issuing of currency. That's other important. Development role. The other function the RBI performs is developmental role. Performs a wide range of promotional functions to support national objectives. So what are the national objectives? Let's say the government of India recently has come up with an ambitious policies, various initiatives to go for financial inclusion, to bring more people into the banking service. I mean, provide access to the banking services. So as a result, you might be aware of it, the initiative by name Jan Dhan Yojana, Pradhan Mantri Jan Dhan Yojana, to provide no-frill accounts to many of people who doesn't have an access to bank account. Is it? No-frill account has been zero balance accounts. So whenever RBI comes, or whenever the government comes with various policy initiatives, similarly priority sector lending scheme, you might all be aware of it. Okay, a scheme by name differential rate of interest scheme. So whenever the government has come with certain initiatives to promote various developmental activities, RBI do also participates and supports government in order to achieve these kind of objectives. So that's other important function RBI performs, wide range of promotional functions to support national objectives. And then the further function is regulator and supervisor of payment and settlement systems. So most of you might be using this UPI, BIM, and then various online transactions. So if you look at all these kind of, I think you might be also aware of this National Payment Corporation of India. So how exactly this payment takes place, okay, from one different bank account to other different bank account, or from one particular bank branch to other bank branch, how are this particular transaction get settled. So everything happens to be taken care by the RBI, and RBI happens to does this job of regulator and supervisor of payment and settlement systems. Okay, so let's say, imagine if a person happens to have an account in HDFC and he makes a transfer into a different person having an account in ICICI. So how does this payment get settled? How does the settlement takes place between these two banks? So everything would be taken care by this RBI, and RBI provides the facility to ensure that particular payments and settlements takes place smoothly within this banking system. Another function happens to be, it serves as a banker to the government and also banker to the bankers. So when I say banker to the government and banker to the governments, like we all have some various types of banks that provide various kinds of services. Okay, let's say some of you might have an account in ICICI, some of you might have an account in HDFC. Whatever these particular banks are providing to you and me is a similar kind of service RBI provides to the governments and also to the bankers. Okay, so I mean the government, both the central government and state governments, if they want, they could deposit their money, they could withdraw money, they could use these bank accounts to make various transactions. So that's what RBI does. RBI acts as performs a very important function, that is, it acts as a banker to the government and it also acts as a banker to the banks. So the banks, when they have certain amount of money, they could deposit, they could withdraw, they could also borrow money, something very similar to the way we happen to avail a similar kind of services from the banking system. Okay, so that's what I have mentioned here. It serves two important function, bankers bank and banker to the government, and the most important and the last important purpose that RBI serves is it acts as a lender of last resort. What do you mean by lender of last resort? In general, imagine in India, if banks are in need of money, generally what are the major source of money for the banks? The deposits, isn't it? Or else the bank could also raise money from the market by selling certificates of deposits, or they could also borrow money from their fellow banks, and that is what we call money market. But in case a bank is badly in need of money and it's not able to raise money from the markets, in such case the last resort or the last option that banks always have is with RBI, and RBI is the one who says, in case if you are in need of money, badly need of money, and you are not able to raise enough money from the markets, then you would be able, you are always allowed, you're always welcome to knock the door, and that's none other than the last resort, that is RBI, and henceforth RBI also said to act as lender of last resort to the bankers. So in this particular session, we discussed about the basic, what is monetary policy, how is it formulated, what are the objectives of monetary policy, and what exactly is the purpose, what does RBI performs and functions of RBI beyond the responsibility of formulating and reviewing the monetary policy. In the next session, we will try to understand basically how RBI uses various policy instruments, what are the policy instruments RBI has at its disposal to alter the supply of money, and how in reality these policy instruments are used by RBI to control the supply of money and achieve the objectives of both growth and maintain price stability and exchange rate stability. So that would be our next part of a discussion. That's monetary policy part 2.